Guy asked me a question that we discussed on the webinar the other day. I replied to an email Guy sent to me as well. He says, what combo of risk and in the money will make a better bulletproof at the onset? There's no such thing as bulletproof at the onset. There's no such thing. That's not how the market works. The options are priced in that fashion. Guy, I took your question that you asked me from the other day and from the email from this morning, and I turned that into a blog at Radioactive Trading. I don't know if you got the email and you were able to check out the blog there at Radioactive Trading. Right here. Okay, let me see. Sorry about that. Let's go to Radioactive Trading and let's go to blog. The article I wrote today is it easier to bulletproof with a lower risk? Okay, so we talk about what bulletproofing is. We look at that thin example, Fabrinet example, and the difference between the lower risk at 75 with only 323 at risk versus what I did with buying the stock around 64.30 and buying the 70 put for a risk of 6.1. Okay, now I don't want to sell the call right away at 65. Why? Just what we showed. Stock is below my put strike price. This increases my risk to the upside in the direction I thought we'd go. That's a no-no. That's why it's talked about in the blueprint. You never do that. That's why I'm not. It puts me in an awkward position. It's not just doing a covered call. You have to consider the entire structure. So although selling the 65 call while I'm holding the 70 put and a cost basis of around $74, $74.50, selling the 65 call handicaps me because I have an agreement to deliver shares of stock at 65 when I've got a cost basis of almost $7,300. I increased my risk to $800. Okay, this is a no-no. We don't do this. You have to take into account the whole structure. And so the idea was, well, if I went deeper in the money and had the lower risk, well, now if you sold the 65 call, because there's no premium at the 70, there's absolutely no premium at the 75 to do these income methods with, you sell the 65, your risk is going to go up to 15%. Why? Because you have a cost basis of 76, and you've agreed to give up your shares at 65 if the stock runs past that. That's not the way to do it. The best time to do the income methods on the bullish side is when the stock is trading at or near your put strike price. So what that means is I don't want to force an income method incorrectly because you're actually going to take more risk to the upside. You're going to put yourself in a worse position. If you go too deep in the money with the put for too low of a risk, you have less expectancy of a maximum profit. It's as simple as that. So take this. I'm going to send the link to everyone. If you haven't done so already, Guy, go ahead and check out the link. There it is. I'll send it to everyone as well. Blog.radioactivetrading.com. You can just go there, but is it easier to bulletproof with a lower risk? By the way, the answer is no. I take this example, and with my 70 strike put done properly, if the stock hit $69 at the end of December, the January 70 call, I don't want to move it, would theoretically be worth around $2. So let's say around December 24th, Fabrinet moves up to $69 per share. January 70 call is worth $2.10. I sell it on my married put and I cancel the risk by half. I don't have a worry about this double dip to the upside that I had by selling the 65 call too soon and below the put strike price. This is a nice range. Now let's say the stock on yours, if I had the 75 put or the 80 put and I sold the 70 call again, I'd be at a risk of $700, $800, $900. I would have increased the risk because of selling the call, and I would have increased the risk to the upside in the direction I thought the stock was going to go. It is one structure, not just selling a call as you want against the stock. You got to take the whole structure into play. But let's say the stock moves up and down and it's at $69.50 at expiration here. Well, then what happens? Well, I can probably sell the February call, the February 70 strike now, and I'm holding the July 70 put, sell it for another $2, and I've dropped my risk to 30 cents. I'm pretty much bulletproof on the married put I have right now, using the 70 put that had the higher risk. Year 75, you wouldn't have been able to sell the 70 calls. You're probably still sitting with the stock and the put carrying a 386 risk, because you wouldn't have sold this for the risk that if the stock continued to move up, you would have had a loss to the upside as soon as the stock went above 65, or in your case even went above 70, because you're holding the 75 put. But here I am 45 days in, almost bulletproof. Now, that's a hypothetical. I'm not saying that's what's going to happen. It'd be nice if that happened. It'd be nice if the stock, I think somewhere in here I said, it'd be nice if the stock gapped up to 73, and you could probably get closer to bulletproof status. But if I let the stock run up to 73 or 74, I could cut 75% of the risk on the married put I have by rolling the put up at that point. I'm pretty sure. But you could lower yours as well, and you'd have less to go. It'd work in both structures, and I'd love to see Fabrinet jump up to $73 in the next few days. But if it just gradually moves, and in a week or so it's trading above 69, that's still optimistic. This 70 strike with the higher risk, because it's closer to the current stock price, will give me more opportunity to get closer to bulletproof than by going too deep in the money, because now you have to wait. You either need a larger move in the stock if you bought the 75 or even the 80 put, which would maybe only have a 2% risk. You have to wait now for the stock to move up, or you need a larger move more quickly to be able to properly apply the income methods so you're not taking a higher risk, double or triple what you started with on the original married put, but to the upside in the direction you thought it was going to go. I think one comment I should make here that's a little bit confusing. When we do talk about bulletproof, we are talking about having no risk to the downside. But forcing a position into bulletproof status on the downside is not worth it if the upside is carrying a risk of 10, 12, or 15% because of an improper structure. That's not what we want to do. That's not it. We're looking at the structure as a whole, not just what my risk is to the downside. I've got to make sure that all of this matches my goals for the position, matches the SIGA model, we call it, for the position as well. So as I said in the webinar the other day, my decade or so of trading this in my portfolio and posting my trades in the Fusion portfolio, Ernie's 10 years of trading this married put technique, Kurt's 20 years since he developed it. The best structure are going to be those with a risk of between 4 and 8%. Not going too deep in the money where your expectancy of profit is too small, because you need the stock to move much higher. Okay? This is the wheelhouse. This is where I want to be. Just like we talked about the other day. We talked about the three bears. You know, Qualcomm, this one might even be a little bit high. I might be tempted to go with the 95 on Qualcomm. All right, Qualcomm's at 88.85. Oh, I'm sorry. Wrong one. Qualcomm's at 88.85. And I'm going to go to the search by symbol tool here. And there's that with an 8.2. What I mentioned in the webinar is that normally what I'm looking at is sort of what I call the three bears. And my three bears are probably right here. Oh, there's a 92.5. All right, so I've got a 92.5 with a risk of 6.95. Pretty high, but to tell you the truth, if I bought Qualcomm at 88.85, bought the 92.5 put for July, I could probably sell a 2-week out, 3-week out, 92.5 call and get 80 to 90 cents, maybe even $1 right now. If I bought the 95, it's a 5.9% risk, might still be doable to get a good premium. But if I went with a lower risk, because I don't want to sell the call below the put, and I don't want to roll the put until the stock's trading at the put strike price. Here, I need less of a move in order to properly apply the income methods. If I took a look at Qualcomm, and I went up to the 110 strike because it has a 2.3% risk, and I say I just have to make up $2.60. Okay? Well, that's true. You just need to make up $2.60. What can't I do on this position right now? I can't go out 14, 20 days out in time. Let's go 20 days out in time. And the 95 call is only 20 cents. That 92 is 69, so it wasn't $1 as I was hoping. So let's try to get $1. Let's sell the 91 call. Right? So I only had a risk of about $2, 2.3%. Maybe it was $3. But I'm going to sell this 91 call 14 days out right now and cut out half of my risk. You cut out half of your risk to the downside. You multiplied your upside risk in the direction you thought the stock was going to go by 8 or 9 times. That's dangerous. This is not a profit and loss chart for a success. Even if you got the premium to bulletproof to the downside, the structure of the trade, because you went too deep in the money, took too little of a risk, you're going to need the stock to be trading now around 108, 105, 109 before it makes sense to do an income method. You're not going to get bulletproof faster, even though your risk was 1/5 of mine, 1/3 of mine. It's not going to happen. You need a larger move now for it to happen.